So you could use a home equity loan versus a regular loan, and you could pay off the exact same mortgage in 7 years versus 30 years, making the same payments that you would always make. And I don't only mean towards the property, but I mean same payments on groceries and everything. And here's how you would do it. So let's just say you made $10,000 a month. Well, auto deposit the $10,000 into the home equity line of credit. So let's just say you borrowed, $500,000. So one, you have a 30-year fix, the payment's never gonna change for 30 years on $500,000. Doesn't matter if you pay off half of it, doesn't matter if you pay off 80%, 30%, the payment's always gonna be the same. Versus a home equity line of credit, every time you pay off a little bit, your payment's gonna go down a little bit. But the catch is the interest rate is variable. But that's okay, because would you rather have your balance go down and your interest rate go up a little bit than basically have the exact same payment and take 30 years to pay off your home versus 7? And so doing it the exact same way, having it deposit, and then basically, home equity lines of credit typically have a credit card, a checkbook, so you can pay for everything the way you normally do, your groceries, you can pay, make a check for your rent out of it, whatever you need to do. But it sits in there, and while that's paid off, that, $10,000 is less, that's $10,000 less interest that's accumulating. Now, let's just say that $7,000 of that you end up spending anyway, so only $3,000 goes to the mortgage. Well, still that $7,000 was sitting there not collecting interest until you spent it. So because of that, it could take you 7 years to pay off the exact same amount, the exact same amount on your house as it would 30 years on a regular 30-year fix. And so that's the power of understanding the math and leverage and interest rates and the different types. So like with a car, same thing. Every time you make a car payment, you're paying down a little bit of principal, but your payment never changes until you pay that car off. And so versus a credit card, you basically, if you have half of the balance, you have half of the payment. That's the difference between a home equity line of credit versus a mortgage.